Pretty quiet crowd, I must say. Yeah. Anyway, so I learned something new. I would say not entirely new, but I have looked at this stuff maybe 3, 4 years ago. But I learned a new usage for a strategy. So I do want to get into that. Yeah, there is always I mean, this is why I love the markets. Doesn't matter how long you have been, there is always something new to learn. So, and yeah, I learned something new. I, in fact, used it on my account, and I'll see, how that goes. But I would share, the details of it. Aditya, hey, good morning. Good to see you back.
Good to see you too.
All right, looks like no other questions or anything to share to start with. So let me get into today's session then. All right, welcome everyone for our weekend discussion around stocks, anything related to investing in capital market stocks, bonds, options, maybe a little bit of alternatives. I'm not a big fan of that yet, but I'm always open to discussions. So today I do want to bring up a topic that I something like I was saying, not entirely new, but something new that I did for my account, and I do want to share it, which is basically if you are borrowing from a broker, you have to pay for margin interest, and but if you use an option strategy, which is what I want to talk about today, you can cut your margin interest um, in half of, or I would say you can cut it by 2/3. I know it when I created the image for our session today. I put in cut margin interest rate in half, but then when I ran the number on the trade that I did, it was like almost 2/3, right? So I do want to share about that, an option strategy that could help you to cut your margin or the rate that you pay on any margin loan by more than half, let's put it that way. So that's one thing which is on agenda. Other thing is Co2 management. I know, Aditya, you are a big fan of those guys, right? So they came up with they did a keynote in East meets West. So they kind of run this conference, doing it for 10 years. I never looked into that before. I mean, I've only started looking at Co2 maybe for 2, 3 years, because it's generally not known on the US side as much as it is known on the in European side. But they did their keynote, and there's a lot of a chatter around that. So do want to cover, especially they talked about top 40 tech stocks for 2030. So I want to go through that. And I know every week we come back and talk about, there's a stock deep dive on Chewy, which is still pending. If we get time, we'll do it. I have almost 15-page report, or what I was thinking is maybe I need to spend some time to condense it into maybe a small deck and then go through it. We'll see. We'll see if we have, based on the time, we'll do that. But I think the two big topics are talking about an option strategy to reduce your interest, the interest that you pay on loan from a brokerage firm, and maybe going to the go-tos list. Uh, the key takeaways from their keynote address. Aditya, is there a way to set a vertical put spread to close automatically when it reaches 70%? Yeah, this is what I always do, right? The moment I have my trade in, and I'll probably cover that, and I'll show you how you do it. You basically put a good to close order, right? GTC order
Yeah.
at 70% of your profit. I generally put it around 60%, because to get to the 70%, you will have to wait maybe till the last week of expiration, unless you have done a trade, which is when the VIX is above 35, 40. at a normal level of VIX, which is let's say between 20 and 30. That's not normal, but let's say nowadays that's become a normal. If you have to wait all the way up to 70% of max profit, you probably will be going into the last 2 weeks or maybe the last week of your expiration. And at that point of a time, you face much bigger gamma risk. So what I have started doing it is I generally keep it at between 50 to 60%,
Right.
because then maybe within 2 weeks I'm out. But I'll show on toss how to do it. It's pretty quick. Basically it's a GTC order, and you put your limit price, which will give you equivalent to whatever 50%.
Right. Thank you. Thank you, Rick.
All right. Anything else before we get to our session? Any other questions that you may have? And let me just address and show how to do it on toss. Yeah, 50% is fine. So I used to be on 50% because 50% is what Tasty Trade have been talking about. That worked well when the VIX were around 16, etc. But nowadays I moved up from 50 to 55 to 60. Again, with an experience, you'll figure out, because the VIX has been little more elevated in nowadays than what it was in, I would say, 2018, 2019. I mean, believe me, I've traded when the VIX was single digits. So when the VIX is single digits, you're not gonna get 60%. You'll have to wait much longer time. So that time, yeah, I used to get out around 50%, 45%. But nowadays, yeah, I'll start at 60, and then within 2 weeks of expiration, 2 to 3 weeks, if it's not there, maybe I'll get out at 50. Again, you have to find your sweet spot. 70%, I would say, Aditya, is cutting too close. You are basically allowing your trade to get exposed to the much higher gamma risk. So I
Right.
would say tone it down, maybe start at 50%, and as
Sure.
and when become more comfortable, try to increase it.
Yes. Thank you, Rick. Yeah.
Mhm. All right. Okay. So okay, this is a demo. I don't think I have any trade in here. But let me see, is there anything? There is no positions. But the way you'll have to do it is, let's say if your trade has gone in, you just create an opposite order, or you go to your account statements in which you will be able to see your trades, right, in your trade history,
Yep.
and right click on it and say create opposite order, right? So basically that will be a closing trade, and pick up your limit price. Let's say if you sold at $2, then you pick up your limit price to be $1, because then the profit will be $1, which is 50%, and put a GTC order. So if it is a GTC order, and then it is valid until you cancel it. So you don't have to come and monitor it every day and check the prices, because 50% means if you're sold for $2, you should be closing at $1.
Right. Right.
And Nick has another one. You can use a bracket orders, which is like stop loss as 2x. That also, Tasty Trade does suggest that sometimes the trade has gone so far out that there is no, there are less chances of it recovering, and then you that time use a stop loss at 2x. I personally haven't used that, getting or stop loss at 2x.
Yeah. Because I guess in that instance, I'd rather take the stock and wait for it to come back.
Yeah, I mean, and I know why Tom and Tony suggested, because they don't want to take a stock assignment, but because I am a owner of the stock, I would rather, if it falls down, yeah, I'll take a stock assignment and then try to reduce the cost basis from other sides. Yeah. Yeah, Jay says sometimes like collecting pennies before knockdown. Yeah, waiting to for the last 10, 15, 20, 30% juice and trying to collect it. That's where exactly is collecting pennies. I mean, if you made 50%, why subject your trade to the huge risk, right? Especially I've seen in some cases, right, when the VIX will spike to 40, 45 momentarily, I will just go and sell, delta neutral trade, and when the VIX comes back down after 2 days, I'm looking at that I've already made 30 to 40% of what max I could have made, right? And then I would even close it within a week, because why subject the trade to next 4 weeks, 5 weeks of volatility, just to make the remaining 10%, because generally I'll close it at 50%. It's already making 40%. I'm like, okay, I'll close it now. It's all about how you want to manage the risk in your trade, right? There is no right way. Depends on your own personality, and your own risk management, right? If I generally close trade at 50 or 60, which is like 40-50 days out, and I open a trade and within a week it's making 40% of the max instead of 50 or 60, I'm like, I'll close it within a week then. Right? It's just that the longer the trade is open, there are possibilities of it being subjected to a lot more volatility, right? And I don't want to then get into a situation around, oh my gosh, I was making 40% of the max, and then later on Trump did something or whatever else had happened in the world, and the trade that was making 40% of the max is now back to losing, or whatever. I lost all that. I didn't do that again. So again, depends. Sometimes you might feel, oh my God, I came out early. I could have stayed in the trade. You'll figure out your own sweet spot. More you trade. That's what I would say.
No, thank you. Thank you. That's very helpful.
All right. So let's get into today's session. Hey, morning, Ravi. Good morning to you as well. Dave is saying, I also closed out a long 30 call in August 15 for MP at 105. It was 895 and I closed it out. Yeah. Especially on the long side, if you're bought a option, it is the most difficult decision, right? On the short side, it is easier decision. If you're selling option, which is what mostly I do, it's an easy decision to make when to go out, because I know for sure, I can't make more than the original premium that I've received, right? But when it's in a long one, it's always very tricky decision on, I made double my money. Maybe I made three times. Oh my God, should I get out? What if we become a GME? So that's always a very emotionally very tough decision. Okay, so let's get into today's session. Hopefully I'm sharing the screen. Yes, that is correct. You guys are able to see the document? No? All right, then everyone, okay, familiar faces. All right, so let's dive into today's session. As always, everything and anything that we discuss here is only for education, right? And entertainment, not an investment or financial advice, right? I have to say these words. Ron says he's for the first time. Okay, he's maybe a different Ron, or maybe I'm getting confused with Ron and Ross. Welcome, Ron. Good to have you here. And hopefully you'll find something that interests you, and we'll join again. Maybe if you want to quickly introduce yourself, 30 seconds, well, that'll be great. And we will get to know what kind of investor you are. Ron?
Can you hear me?
Yeah.
Yes, thank you. I was eating. Yeah, thank you, Vivek. I happened to see your meetup in the Wednesday meeting with the Massey group.
Oh.
Jonathan Massey, you mentioned it, so I just joined. I'm primarily work on options, equity options, and futures. Options for the most part, as you all pointed out, option selling, and pretty much covered a call, and a little bit of put spread.
Okay.
Tried butterfly. I'm very familiar with butterfly and straddle and strangle, those kind of things. Found that the sweet spot is on the covered call, buy right, so to speak, and put right.
Cool. Yeah, I mean, yeah, there are tons of strategies, and I generally will do anything that works for me. But yeah, you have to find out what gives you, I mean, what works you best, because there is no single strategy that will work for every kind of investor.
Right.
So yeah, I'm glad you figured out what works for you. Most of the time, it takes a few years to know which works for me, right? People will try to follow someone else and then say, oh, this doesn't work, that doesn't work. But glad you at least know what works for you.
Yeah, I have many things to talk about, but I will not steal your spotlight, so continue.
Sure. Okay, so let's look at the overall market first before we get into the main topics. Overall, I mean, the big thing that we happened this week in the market was FOMC meeting, and then more importantly, what Jerome Powell has to say. So I don't think there was any surprise in terms of what FOMC decision would have been this week. So a lot of anticipation was in what he's going to talk about for future, right? So there is no change in the Fed funds rate, still 425 to 450 basis points. But one thing which at least in this one I found a little different from Powell's speech of the past is I found he was talking from both sides of his mouth. Every time whenever reporters will question him around why don't you reduce the rates, or president is talking about it, he always said that we are data dependent and data still shows that inflation is not at 2% yet, or whatever the reason is, right? So they don't want to speculate in future what might happen. But this time I did hear him talking about that, hey, we're not going to reduce the rates because I may expect that because of tariff, the inflation could go higher in future, right? That was something which I've not heard him talking, using this earlier. So which was a little surprising for me. I'm like, you can't now talk and include the future impact only when you're talking about why you're not gonna reduce the rates, because then the other side that could come out is, hey, look at the labor market, maybe market could be weak, look at the productivity gains that we may have from AI, etc., so that and inflation may not go high. But at that time, he would always say, no, I'm only data dependent. Today, data shows this. We don't want to speculate about future. But this time, I found that he did speculate about the increase in inflation because of the impact of tariff, right? And he did consider it. He did say about this during the press conference, saying he is expecting the inflation to increase. And at the end of the day, if inflation does increase, then history will always talk about that the Fed could not control inflation. They're not gonna come and say that it is because of a particular administrations, the actions of the administrations that caused the inflation to increase. So I think that's what he's keeping in mind. A little bit speaking from both sides of his mouth, I found in this press conference. But I think market has started to price in, saying maybe no more rate cuts in July. Maybe we will get the first rate cut in September. I say 65% probability of 25 basis points rate cut in September. And beyond that, I think it's like nothing clear. Maybe we just get one rate cut. Who knows? Or maybe none. If because today the tariff impact is not yet seen, right? We talked about it last week, because companies will generally have an inventory of maybe a quarter or a few months. If the impact of tariff, if there is any increase in inflation, we should only see it in around fall. So I'm expecting maybe September, October, November kind of a time frame. And if that happens, maybe we'll get no rate cuts. Right? So we'll see. But for now, market has priced in that there is no cut happening in July, maybe one in September. And Dave is right. Other countries are dropping their rates. Yeah, I did not follow specifically Switzerland, but I know that ECB dropped their rates. And that's what Donald Trump keeps saying. The other countries are dropping their rates. Why not us? Right? And now there's little more fear. Is he going to fire Jerome Powell? I mean, by law, he cannot. Powell has to resign. But I guess for a few more months, we will see the back and forth between president and Jerome Powell. So that was a big news at a very macro level, FOMC. Other stuff was we saw Meta, right? So Meta is like going big on AI. Zuckerberg is a little frustrated because the Llama 4 didn't go that great. And he doesn't want to, stay behind while someone else will take the lead. So today, And it's not just Zuckerberg. I mean, today the whole race behind building the whole data centers and spending tens of billions of dollars on AI is considered to be winner takes all market, right? If you become AGI, or now a new word is ASI, right? AGI was um, general intelligence. Now ASI is a super intelligence, right? Artificial super intelligence. And the market thinks that whoever gets to this first will get everything, right? And that's why now they're willing to spend billions and tons of billions of dollars, or maybe hundreds of billions of dollars, if you combine all the hyperscalers AI related investment in infrastructure. In 2025, it is supposed to be more than $350 billion, right? Because I think if no one wants to be left behind in the race, because they assume it's winners take all. So Zuckerberg, Meta, they spent close to $15 billion, right? More than $14 billion, less than 15, to acquire 49% stake in company called Scale AI. Scale AI is a relatively new company, maybe a few years old, 6 or 7 years old. Imagine now that's being valued at $30 billion. Its founder is what, 28 years old, Alex Wang. And so what that company does is it labels a lot of data, which will then be used by these LLM models for training purposes, right? So for example, you see a picture of a cat, it will label it that it's a cat, right? This is a very crude example, right? A red light, traffic red light, it's a traffic red light, right? You go at a little higher level. For example, you ask a question, right, which is not set straightforward as a picture of a cat. It will actually try to label uh, it, and in terms of what you're trying to infer from it, right, from the words. So Scale AI deploy hundreds and thousands of manual data labelers in low-cost countries like Vietnam, Southeast Asia, China. So they have an army of contractors whose job is to look at the content and then maybe label the content. And now that is being used by a lot of these model developers for their training and inference purposes. So right, so Google, OpenAI, they all are customers, or let me put it, they all were customers of Scale AI. Right? And also the founder Alexander Wang, he has got a great connections in Capitol Hill, right? So now Zuckerberg doesn't want to be left behind. Basically, this is kind of an acqui-hire, because you cannot acquire the company. We haven't had a good acquisition in the last many years, right? So regulators have been very strict, and looking through microscopic lens on any acquisition. So this is kind of an acqui-hire. That's why I did 49% stake, not a majority stake. And the day after this announcement, the CEO of Scale AI, Alexander Wang, he's now getting in, reporting in Meta's office. Probably he'll be leading the new initiative around artificial super intelligence, right? Maybe the whole Meta's AI team. Number two, so this is like a war happening, right? So Sam Altman of OpenAI, he talked about in a podcast saying Meta is trying to basically poach OpenAI researchers with $100 million signing bonus. And this is just a signing bonus, right? The salary is even higher than this. So Meta is trying to go. We don't know, right? How much is the truth in this? It's just Sam Altman's statement is saying that they are trying hard to get the best people, and he says, I'm happy that none of the top people decided to leave us, because their mission is more than just making money. I mean, all those AI researchers, they are already multi-millionaires, right? Maybe centimillionaires. So now their mission, they get motivated by building something and be first in the race rather than another $100 million, right? And then we also got to know that He's in talks to bring in the co-founder of GitHub, Nate Friedman, to come and join Meta. Right. So yeah, so that kind of reeks of a little desperation on Zuckerberg's side, especially after the Llama 4 didn't perform, I mean, got left behind in the race against the OpenAI's and Google's Gemini models. He is trying hard to get back and try to fill up the overall tech stack of AI, right? You got from a labeling, now you got from, let's say, the co-founder of GitHub. You would know the whole, how the connections and are made when you're talking about a code generation using LLMs. Probably we might see some more new announcement of trying to get some hardware people onto their AI journey, right? Because a lot of these AI models, if we can tightly integrate hardware and software, it becomes much, much easier and quicker to execute those, right? So the bigger question as a Meta shareholder for us is the Zuck's actions justified paying like $14 billion to acquire 49% of a company which is what, few years old, private, so we don't know how much of the revenue it is. Probably it's not making any money, that you can assume. And he's like valuing it at $30 billion. And then it's trying to get talent by paying, okay, I give it to you, like $100 million maybe, on the extreme side, but won't be surprised if tens of millions of dollars for the top AI researchers. What do you think? Meta shareholders, who are the Meta shareholders here? I mean, I am Meta shareholder, so no shame in being a Meta shareholder. So Dave says, what do you think? Is it the right move? Is it too expensive for Facebook or Meta to do this? What's your opinion? So this is where our thinking needs to come in, right? Zuck has done what he has done. What do we think? Is it the right move for Zuck or not? Jose says Zuck has a good track record for acquisitions. Yeah, I give that. The one of the best acquisitions of all time is Instagram. And then WhatsApp. Now they're trying to monetize WhatsApp. So maybe he'll figure something out. So looking at Meta, and let me bring up Meta stock, right? If we look at Meta, $170 billion revenue. More importantly, if we look at, they got almost $70 billion on their balance sheet. Right? And Meta is what? $1.72 trillion company. Now, maybe half of its valuation, or if not half, let's say 25% of its valuation is driven by the fact that it's going to be a big company on AI, right? So if we take half, which is almost $800 billion, or maybe $400 billion valuation is just on that it's going to be a big player on AI, right? So if you have to spend $15 billion, $20 billion to save that $400 billion, I think that's justified. Like $15 billion is a big amount of money, right? It's not a pocket change. It's a huge money for some companies. But when you look at a Meta, like $1.72 trillion, and it has got $70 billion sitting on its balance sheet, yeah, you could spend $15 billion. So I would say, even though these moves look to be too extreme, saying why you're paying like $15 billion, if that $15 billion saves it $400 billion or $600 billion in market cap, I would say this decision is justified, right? So it's a no-brainer. Go ahead and spend it. So I think I would say, I'm not too mad at Zuckerberg because the balance sheet can support it, right? If he had to take loan to do it or raise another financing round by diluting shareholders, discussion could have been very different. Or if you would have taken like 50% of your cash on your balance sheet, we could have had a different discussion around it. But by spending $14 billion, yeah, it would still be more than $50 billion on its balance sheet. And, they generate a good free cash flow, right, every year. So which will come back into, to refill the balance sheet. So I think I'm still okay with it. Dave says, I regret I sold my FB 2000 shares bought at IPO. Yeah. But, you still held your Microsoft, Google, okay, Meta. Yeah. Everyone has a stories, right? What do you call, in hindsight is always 2020. Tyler said I sold 1,500 shares. You're in SoundHound, voice AI. Yeah, I know SoundHound was a hot stock. I don't know where it is now. I'm not invested in SoundHound. I don't 102. It's a pretty small company, and no, I don't like SoundHound. Like in 10 seconds, I don't like SoundHound. Not yet. Not yet. Right. They're they're still an infant, and I don't think I'm right now willing to invest in infants. Let them grow to be a little bit more responsible adults. Uh, it's okay. I can invest in them late. Not for me right now. What else? TSM's May numbers came out. So TSM had reported so TSM, they report their monthly numbers in terms of their revenue, right? So their May numbers were like up 40% year over year. And which is like, it's not a small company. If you look at TSM is TSM. This is Taiwan Semiconductor Manufacturing Company, and this is almost $1 trillion company, right? And it's growing a revenue at 40% rate. These numbers are in Taiwanese dollars, but growing at a 40% when you're already close to $1 trillion company, right? It's amazing. Again, why? Because TSM makes the most important chips that the world needs. And with the AI, every company needs faster and faster chips, right? So talk about Nvidia, talk about Apple, talk about Micron. They all go to TSMC and have them manufacture chips for themselves, right? What also amazes me is it's a margin profile, right? Now Nvidia doesn't make the chip, so it's a chip designer, right? So I can understand that Nvidia, their margins are great, but looking at a TSM, which is actually chip fabrication, so they have to spend billions of dollars on building the fabrication plants, buying machinery, going through 10,000 steps in producing chips, right? And they make chips for Nvidia, Apple, Qualcomm, Broadcom, AMD, for everyone. Still, their margins are great. So their margins are like software company margins, like almost 45% operating margins, and net margins like close to 40%. So these are the margins I've seen in SaaS companies, in software companies, which are capital light businesses. This is capital heavy business. I think there was a news again that TSMC planning to invest another $60 billion on their fab plant. It's a capex heavy business, but they run their operations so tightly, so much focus on cost, that they're still able to squeeze in the profit margins of close to net profit margin close to 40%. That's something, it's just blows my mind on a manufacturing company giving you these margins, these software like margins. I don't think there are very few companies who will be able to do this. I mean, there are many software companies who have a worse margin profile than this, wherein they are even capital light businesses. So, am I happy shareholder of this? I think I'll probably hold it forever if the company continues to perform this way. Okay, Ravi says, how about Spotify? I don't own Spotify. Maybe sometimes I feel I miss the bus, but I think it's a good business. Spotify earlier had a little bit scares of can they grow, but now they have shown that they can convert their free users to a premium ones, and the business have been doing good. I'm not a owner of Spotify yet. I mean, so I have not done a deep dive or looked into the numbers, but I've heard good things about the turnaround in their business on Spotify. Dave is saying on fundamentals always the lower P ratio is better, but recent some analysis say higher P ratio is better. Jose has the right answer, saying focus on EPS growth and earnings growth. Right? Sometimes the lower PE is because of a reason. Right? And again, it's not a black and white answer saying higher P is always good. It always has to be based on how the business is growing, how can they continue generate or increase their EPS. And if that means if the business continue to do good or the outlook is better, it will always be at a higher PE. Great businesses are never available at a cheaper price, right? So we have to pay up higher. But the main idea is that identify that you are paying higher for a business that is good, because there are many businesses which just get momentum because some momentum traders will be behind it, and they'll run up to higher PE, but they may not be great businesses. So I think that's what the main focus would be. Traditional value investors would always try to focus. They generally focus on just the low PE. But growth investors want to focus on not low PE. They're okay with a high PE as long as the business is growing faster than what they are paying in a higher multiple. I think that's a decision that you have to make. Why did Oracle jump so much this week past earnings? I think their earnings were good in terms of their AI workloads. That's what I heard, right? Oracle is silently has surprised everyone in terms of how good their Oracle cloud is capturing the market, right? So nobody talks about, when we talk about hyperscalers, we talk about top three, right? AWS, Azure, and Google Cloud. Oracle is distant fourth, but if you look at over last 2 years, their share has grown, and a lot of some good companies like Zoom, they moved to Oracle. And with the whole AI stuff, I think they are getting a lot of good businesses on that. And number two, Oracle is also a partner in the whole Stargate, right? $500 billion that US government initiative. So that's what I think Oracle has, stock has done what it has done. So, all right, another one. I think I tweeted maybe a week ago. Oops. I wish all the companies in my portfolio were like this, right? You guys guess which company I'm talking about. So like a lot of other companies in 2022, this company was also going through the rough time, right? A lot of tech companies went through that. We had a lot of a cleaning happening in the market. Many companies were taken to woodshed and then and were shot. But this company's management, including the CEO, they decided and they announced that they would forego their salaries until the company achieved self-sufficiency and profitability. I think they were talking about operating profitability. But in any case, I think this is a good gesture. I've not seen many companies do it. I've seen some company CEO not taking cash compensation. But in this case, it's not just the CEO, but the whole top management layers. They said, we're going to forego our salaries because our stock got hammered and we need to cut down costs. And this was in 2022 when all the VCs, either private, VCs in the private side, and then the public market investors were asking all the companies, show me the cash flow, right? Show me the cash flow. Forget revenue growth. I need to see the cash flow. I need to see the profitability. So this company said, we'll forego our compensation unless we achieve self-sufficiency. They had a 30 million option grants, with a exercise price of $22.50. Those were canceled, and they were awarded at a significantly higher price, $120, right? From as a shareholder, this is a very friendly shareholder move, right? I feel good about when management takes responsibility of, hey, we need to do the right things for the company. I've seen many management firing people, trying to cut down the cost, but never taking cut in their own compensation, right? That's pretty much what we see in the corporate world. So this was I would say, a breath of a fresh air where I saw management doing something different, right? Taking responsibility, saying and also signal to employees is, hey, we are with you in this journey. We are cutting cost in a way that also hurt the top management financially, and not just that you're cutting costs by firing low-level employees. Any guesses which company is this I'm talking about? Everyone? No? Okay, this is C Limited. Right. And so I'm happy shareholder C Limited. Sometimes these are the things which are like, these don't get reflected into the financial numbers, but if you go through the annual report or the quarterly report, you'll see these are some of the qualitative indicators that I want to focus on when I'm building my investment thesis, right? This won't show up in directly in income statement, not immediately, but this does tell us that, hey, you have a management which is having the same skin in the game, and they do think about their shareholders. So I didn't want to talk about that one. There's a question around the WolfSpeed, right? So Jose says, I think their annual is down hard, but quarterly they are trending up, price still hammered. So the problem with the WolfSpeed is the leverage. They took huge debt. So and again, I don't own WolfSpeed. I have not invested in or never looked at it as an investment opportunity, but I did remember reading about WolfSpeed. Wolf, when the CHIPS Act was announced, so I think WolfSpeed announced a lot of projects and capital investments, assuming that they will get funding through the CHIPS Act. So they leveraged their balance sheet, took on a debt, assuming that the fundings will come through. Now that funding has not come through, and their balance sheet is highly leveraged, and that's the problem with the WolfSpeed business model. It's not, again, I don't know what the share price is, what the P ratio is, but if I recollect correctly, the problem with the WolfSpeed was the leveraged balance sheet, and that is what's causing it. Did they announce bankruptcy or something? I mean, one reason why a company go through bankruptcy is because they are too much leveraged. Oh, Tyler says yes. Okay, so then I think my recollection is right. I'm not looked into WolfSpeed. What's the ticker? WOLFSP. Oh, it's a wolf. Let's look at a balance sheet. Total assets. So they got a $6 billion of debt. Let's look at debt to equity. Oh no, ratios. 31.37, right? Crazy stuff. So I think that's what is causing it. So this is specifically to do with this particular company and how they leverage their balance sheet, because their assumption was we will get those grants from the CHIPS Act, and that grants haven't yet come in, and the leverage is killing them. That's what happened with WolfSpeed. Yeah, I remember hearing about WolfSpeed in somewhere. I don't know, did I hear or did I read about it? But that's why I just wanted to pitch in. Is not, I mean, that doesn't mean that every other fab company or every other semiconductor company have problems. this problem with the WolfSpeed is very specific to how management decided to leverage their balance sheet. And that bet, I mean, leverage cut both ways. You guys know. All right. Looking at the sector performance, S&P is like barely positive for the year, 1.47%. Industrial sector is 7.78%, right? And discretionary and health sector have been laggard for almost every week. Every week when we see it, discretionary has been in red, right? Little bit scare that we got on Friday, and that's what caused markets to go down, because the semis were down on Friday because of administration had rescinded the ban. The administration had rescinded the revoke on the ban of diffusion, that whole AI diffusion law that Biden administration has put in, right? So that means companies like TSMC, companies like Nvidia, etc., those who were allowed by the administration to start to sell the chips to some companies in China. The whole diffusion rules that Biden administration put in, Trump administration had revoked it. Now they have rescinded their revoke, and that's why a lot of semi stocks were down. There was a question on what happened to Google. For Google was down because looks like the close to $4 billion fine that EU had put on Google. They had appealed in the whatever the highest court of EU is, and then the attorney general or advocate general, whatever, some big legal authority on that court has said that we will recommend the court to dismiss the appeal. Right. Court has yet to decide and pass a judgment on it, but going by the history on the court, if the attorney general says, or if the attorney general advise something, the judges of the court generally go with the advice of the attorney general. So it looks like that Google's appeal will be rejected, and hence they will have to pay whatever the $4 billion fine that EU administration, what are the competition authority they had put on Google. And I think that's why the Google got impacted on Friday, because looks like their appeal will be rejected and they'll have to pay that money. That's what happened with Google. What else? Am I seeing some signs of fraud? Little bit. So why? Because I've started to see that on Twitter. Oh, no, it's not Twitter, right? It's X. A lot more screenshots coming around. Hey, look at my whatever portfolio. We made 10x in 2 weeks, starting at like 100K, and I'm already up. And now I have a Discord on which I'll give all the buys and sells, right? Let's become multi-millionaire together. It's just like it's beginning of June 2025. It's like a 2 weeks old, and the bragging has started on Twitter, right? This is just one example of the screenshots. I've started to see these pie charts and these glowing YTD performances back on social media. Probably maybe back on TikTok. I don't use TikTok. I don't use Meta, Facebook. I'm only on X, so I start to see a lot more screenshots. And then Skamat or Chamat is talking about SPAC. So he did a poll on X saying, should I do a SPAC? And then I think close to 60,000 people responded. More than 70% of them told, no, don't do SPAC. And there was a community note on the poll, which was saying that, previously he had done a SPAC and which has lost billions of dollars for investors. Right? He's going to do it again. He responded saying a lot of his Wall Street and the crypto friends are asking him to do the SPAC. And he say, I'm going to do the SPAC. Retail investors, please stay away from it. It's not for you. And he did mention saying, in all my filings, I will put this community note as a big disclosure saying that I have lost billions of dollars. World knows about it. So that was a funny one. Maybe Let me find that out. That's the Chamath's tweet was there. So, but he's back to create a SPAC, right? A little bit frothiness in the market. Now everyone is talking about SPAC again. New IPOs that are going to the moon. Guess which one is this one? 675% year to date. And the IPO happened maybe 2 weeks ago. Right. It's already up 675%. So it's all like everyone wants a piece of this company. Ramesh saying clear. No, it's not clear. Maybe you're on the right path. Yes. Yeah, Fred, you got it right. This is Circle, the stable coin, the US, the company behind the stable coin USDC. The share opened at what? I think the IPO was priced at $30. I don't know where it opened. Maybe opened at 60. I remember we talked about it last week, saying the moment it opened, it was like up 100% and closed the previous week at maybe 165%. And that time it was like $120 or something. And now it's at 240. Look at
Shorting it.
the
I'm
problem.
shorting.
You can't short it. I mean, I don't want to.
With
I don't.
options. With options.
Oh yeah, do they have the options enabled yet? I didn't even check into this one,
Oh
right?
yeah.
CRCL. Oh yeah, the options are out there. Right? Again, you'll have to first of all look, how much float is in it. Is it hard to borrow or not? If you're trying to short it by selling a call or even call spread, you got to be a little careful on that. I've seen if the stock is a little hard to borrow, etc., then you might, if you're selling a spread, you might think that your loss is limited, but based on the availability, HDB, and the amount of the borrowing cost that you may have to pay, I've seen people losing money even on spreads because they did not understand the early assignment or broker forcefully closing your short call because it's a really hard to borrow stock. So you got to be careful and think about that. Maybe buying a put spread, possible. I mean, puts are super expensive. You're paying, if you're looking at here, you're like $48. Take a midpoint, maybe $47 for a $240 strike price. So that's makes it what, 47 divided by 240 is like 20%. 20% cost you have to pay, or maybe do a spread, right? So, and it's trading at like 149, 150% volatility. That's why you have to pay. Yeah. So again, up to you. What do you want to do? But this I do consider as a sign of fraud. I know what Circle does from a business model perspective. I mean, they can come and talk about it, the product or the revenue per employee is so great. It is all because you can just stash in that you can just generate 4.5% by investing in treasuries. That's all they're doing. Their business model is that. What if the rates come down? And you don't need too many people to run this business, right? It's just that currently the rates are 4.5%, which you don't have to pass on to your consumers, your customers, and their cost is the charges that they have to pay to Coinbase, so that Coinbase and other exchanges list USDC, right? That's their cost, right? And whatever the small amount of staff that they have to run the operations. And if you really look at a Circle on how much of the AUM they have through, let's go and look at Circle. Let's go to Gecko and USDC are $61 billion. $61 billion that crypto traders, investors, crypto institutional investors have given it to take USDC. You put the $61 billion buy US treasuries, you're making $15 billion per year. Cost you have to pay to Coinbase for listing charges, etc. Pretty, it's a per employee. It's a good business. I mean, per employer revenue or the profitability is high. Same is the case with the USDT, right? Their per employee profits or revenue is the highest among all the companies, right? Forget about the financial service, but all the companies, because it's $155 billion. They're freaking if USDT is a country, it holds treasuries as more than many of the countries in the world. Right? So, but is that a business model that you want to get behind and pay $250 for the stock? I don't think so. At least I'm not gonna get behind. But yeah, someone wants a piece of it. This is one of the pure play crypto company, and some institutions want exposure to it, so be it. Companies with $0 in revenue are at currently close to $10 billion. Again, which company is it? Any guesses? It's got $0 in revenue, but future is great. No guesses? This is the company, Oklo. Basically, it's a nuclear energy company, and given the whole insatiable demand of energy that we are seeing coming from AI and basically hyperscalers and AI, and recently Oklo also signed a deal with the Defense Department for some energy deals. It's all about futures. Currently, they have a zero revenue, and the market cap is close to $8 billion. I'm not saying this is a fraud or anything. All I'm saying is investors are willing to pay a lot more for a future growth, which nobody knows what the future holds, right? So you have to be really, really lower your guard to be these kinds of investors. And when everyone lowers their guard in the market, that's where we call it, bubbles are happening in the market. Right? So if you look at Oklo, and let me bring up Oklo, OKLO. And many of these companies are like, I know Wolf was being talked about in a lot of Twitter spaces of retail investors, right? Some retail influencers, they used to talk about Wolf. Or Oklo is another company that is being talked about among the retail community, right? If you look at it, yeah, it's not 10 billion anymore, but let's say $8.5 billion, zero income. The revenue is not even there in their income share, in their financial P&L statement, because there is no revenue. So it's all based on the future growth. Yeah, it's like a VC kind of investing, right? These companies should not be in a public market. But it is, and people want to put in money. It's their money. It's a free country. You do what you want to do with your money, right? So is it a bubble yet? So there was, this discussion started because in one of a WhatsApp group, somebody asked, hey, are there any people who were invested in 2021? And do you think we are at a stage of 2021? Right? So I gave saying, these are the things which I see, gives me feeling that there's a froth in the market, but I don't think we are there yet where we were in 2021. Again, this is my personal opinion. We were doing these sessions every week in 2021 also, right? Because the macro environment is different. In 2021, we had a zero interest rates, so a lot of liquidity in the market. Right now, the interest rate is whatever, 425 to 450 basis points, the Fed rates I'm talking about, right? Which is, is very different environment. So I don't think we are at the peak of the froth yet. There is a lot more room for the bubble to grow, if it is bubble at all, right? Markets can stay higher, right? That doesn't mean it's a bubble. A high market is not always a bubble. And if Fed cuts interest rates, that's going to be another tailwind behind this market. We got a rate cuts. We have a deregulations. maybe we have a better than feared tariff rates. They could all push the market higher. So, and so I don't think we are there yet where we were in 2021, wherein everything was already in support of market, right? 0% interest rates, people sitting at home, and working from home, so you can always have another monitor or another laptop where you could be trading on the side, right? So a lot of investors that are like, they got a full-time jobs to do, are not putting money in the market. There is almost $7 trillion of money sitting in the money market fund, right? That is not yet coming into the stock market. So even though I've started to see some signs which you could call as frothy, signs of frothiness in the market, it's possible that the market continues to go higher because there's a lot of stuff that was available in 2021 is not there yet, and there are a lot of stuff which could actually be a tailwind we have yet to materialize in the market. But every bubble bursts with a different reasons each time, right? So if I'm trying to compare 2021, I don't know if it's the right thing to do or not. If this time bubble could burst, we'll only get to know in a hindsight. How did I miss this? It happens every time it happens, right? After it bursts, then we realize, how did everyone miss this? But that's the nature of the markets. Always go through the cycle. There will be always exuberance, euphoric, bubble will continue to go bigger and bigger, and then will burst, and then we'll be looking at each other face. Oh, it was written on the wall. How did you miss it? But that's the fun of being in the market, trying to play the market, and recognize with your own risk appetite in terms of how you want to be, where you want to be. So there is no single right or wrong answer. And that's why I have a very tough time when someone says, what should I invest in? I have no idea. I can't tell you because I'm not you. My way of investing is different. So should be yours. You have to find out what's your style of investing, what works for you. Right. Anyway, so few thoughts on the market. Looking at the crypto market, I don't think this is the latest one, but let's look at the latest one. Crypto market is always open, so things change every minute. Well, nothing much happening. If you look at the asset values, nothing much has changed. Pretty much range bound. Look at a Bitcoin being between 100 or like 90 and 110K. This $20,000 range has been going around for almost 6 months. But something that has happened in the market, which is what I do want to talk about, is we had a Genius Act passed by Senate. There were a lot of amendments that have happened. The last week there were like a lot of questions around what the heck, why it's taking such a long time, why the senators want to make so many amendments, and sometimes we felt that we may not be able to get it through. But finally, Genius Act is being passed by Senate. Now it goes to the House. I in fact searched for what the heck Genius means: guiding and establishing national innovation for US stable coins, right? So essentially, this will provide a framework for stable coins, clarity on who will regulate it, how should it be regulated, what are the requirements, who can issue it, and what kind of reserves you need to hold. I can't issue the stable coin and hold all my reserves of debt of, let's say, Hong Kong companies or a company in Cayman Island, corporate debt of a company in Cayman Island, right? Now we have regulators who will set the rules around what kind of a debt, what kind of a reserves backing those stables need to be held. It gotta be US treasuries, maybe some corporate bonds. If a corporate bonds are on what quality, what rating, etc., etc., right? And then some around the consumer protection. We don't want to end up in a situations like USDT, not USDT, the Terra Luna, that blew up, wherein the algorithmic stable coin behind the Terra Luna ecosystem. I think that was called USDT, right? The Terra's stuff, right? $60 billion just blew up. It wasn't stable at all. And I've seen many other stable coins. There was a Iron Finance. They had a stable coin, blew up. So, and then those who are holding these assets, which become worthless, lose all their money. So there will be some safeguards or around how to protect consumer, right? So now this will go through, to the House, and then we'll see finally, if both passes through the both sections of Congress, will be on a president desk.
Vivek, I have a question related to stablecoins.
Yeah.
I think we were just looking at Circle. Don't they? I know they keep all these US treasuries and that's how they make money, but don't they also have to pay interest to the stablecoin holders?
No, that's the whole problem. If you pay interest, it becomes a security. So today they can't even pay interest. We want interest. So if you hold stable coin, you're not getting any interest. If the moment it becomes yield bearing, it'll become security.
Right.
Legally, so, and nobody wants to be called a security right now going through under SEC, right? So they don't pay any interest. If you hold USDC, they don't pay any interest to you. What they do pay is to exchanges for the listing fee. And Coinbase earns a lot of revenue from Circle through that. They don't pay any interest to you. Now, there's a way to get interest. And maybe that's probably what the question behind the question was, is you have seen some people actually getting interest by using USDC, etc. The way you do is you have a USDC, you take the USDC, go to platforms like Compound or Aave, right? And stake your USDC or give your USDC to them. They could give you, and these are like some decentralized exchanges, they could give you interest, etc. But these firms don't give any interest. In 2020, 2021, we had companies like now bankrupt, right? BlockFi, Celsius. If you give USDCs to them, they were paying 8% interest. Circle doesn't pay it. And then, those companies went bankrupt because they were basically using these digital assets to give it to their hedge fund clients, who would then needed to do some trades, and those hedge fund clients will use to give them like 14%. They will keep half of it they'll pass on to the consumers before everything blew up. The hedge funds blew up, Three Arrow Capital blew up, and when the hedge fund can't give you back the money, the BlockFi blew up, Celsius blew up. Nobody understood the whole risk behind it because every asset was over hypothecated and all that. We don't want to go back into that. That's like a PTSD of 2021 and 2022. But no, Circle doesn't give you any interest rates.
Yeah. Okay. I think I think I saw something on Coinbase where if you stake your USDT Tether, then it gives you something. But
Coinbase may give you, that's a staking yield which Coinbase is offering you.
Right.
Right. But it doesn't come from Circle.
Right. Thank you.
Cool. All right, last one on the crypto side is always follow the actions and not the words. And this has saved, I won't say saved me, but this is where, whether it's a crypto world or whether it's a traditional finance, analysts will come and make some proclamations, CEOs will come and talk about it. All don't follow the words, always follow the actions, right? Jamie Dimon, we know that it's been a dead against crypto assets, Bitcoins. Like 2021, Bitcoin is worthless. In one of, I think this is from 2022 or 23, where he was like in front of our legislatures, and during a Senate hearing, he mentioned that he would close down crypto if he was a government. Said this ecosystem should not be there, right? But on the action side, this has been a JPM coin that has been existing since 2019, right? They've been using it for their own internal settlements and all that stuff. And very recently, when there is money to be made, everyone will jump in, right? Forget about the words. He said that we'll let clients buy Bitcoin. Why would you let clients buy the stuff which is worthless and should not even exist? Because there's money to be made. At the end of it, there is money to be made. And not only, and now they are talking about partners with Coinbase to launch deposit tokens. And most recently, now they're saying we'll give you financing against your corporate assets. When there's the money to be made, everyone will come in. So don't follow the words, follow the actions. That what's the incentive behind, what's this? The incentive Charlie Munger used to say, right? Tell me the incentive, I'll tell you how the person would behave. The incentive is to make money. Yeah, they'll get into Bitcoin or whatever, as long as they can make money out of it. Now the regulators have clarified that there's a lot of regulatory support behind Bitcoin. Then whether it's a toxic asset, whether it's a rat poison, JB Morgan knows that they can make money out of it. So yeah, let's create products. Let's sell those products. What you used to tell that it's worthless and should not exist. Yeah, we are ready to sell it to our wealth management clients and whatnot, because now you can make money out of it. So thought I'll bring it up because I see this, whether it's traditional finance or crypto, happens all the time. So don't go and see what this analyst is saying. Maybe go and see what the positions are. Right? Haven't we seen a fund manager coming and pumping up a stock on CNBC? And when the CNBC host asked him what the company does, he had no idea. And then said, "Oh, sorry, I can't hear you." I think that guy probably is not gonna come on CNBC anytime now. Okay, so final one, buys or sells this week. Again, not a recommendation, but because we talk about stocks, I want to be transparent. So ARKK had a covered call I'm happy to get it assigned because this is the last ARKK unit I had in my portfolio. I'll have one less ticker to track. So I thought, okay, let it be called away. Other than that, no other stocks buy or sells this week. All right, any other questions? Before we get into the next topic, which is using box spread option strategy, how you can cut your margin rates by 2/3. Right. So let me ask the question. How many of you are familiar with spreads? Option spreads as a strategy. How many of you are not familiar with it? Patients, I always use spreads, not much familiar. I am. Okay. So yeah, I don't do generally in these sessions, I don't get into detail, but this is something new I tried. So I thought I'll share, especially useful if you are trying to, have a margin loan from a brokerage firm. Maybe look at this options as a box spread. Okay, so let's get into this, try to understand what this is. So I'm gonna start with very basically in terms of what the spread is, and then we'll get into the construction of box, and I'll give you and end it with an example of it, the trade that I executed in my own account on Friday. Okay. All right, so let's get into the box option strategy. First, the basics of spreads, which is called vertical spreads. So it's a combination of option buying and selling, right? I have covered these in one of the option bootcamp sessions last year, which is of how can you use options for a small value account, right? If you have an account which is like only $10,000 and and then you can say, oh, how do I trade in a stock which is like trade for $1,000, right? You can actually create a spread, and you can define how much risk you can take by doing the spread, and also how much amount get blocked for the trade. So even if you have a small value account, you can still deal in options by doing spreads. It lowers the maximum profit also, because you're putting less money at risk, so the profit will also be less. There is no free lunch here. It is known as vertical spreads because the prices are aligned vertically on option chain. So for those who have not done spreads any time before, maybe fire up your trading platform, because I will have a hands-on exercise for you to maybe create a spread. So for example, a short put spread. In this case, short means I'm selling. Put means it's a put option, and spread means it's a spread. Right? So what does this constitute? First of all, strike your short put is a strike price at which share will be assigned to you. If the stock goes below the strike price, and then you have a long put, basically two puts. One is selling, another going long means you're buying, and that's how your maximum risk will be the width of the put, and the strike of the short put is higher than the long put. An example. Let me give an example. Open up your trading platform, go to NVIDIA, and I'll create it right now. Create a 140, 135 put spread, right? So NVIDIA, July 18th, if I sell this put, let's first do the naked put, right? If you sell the put, like $14,000, it will get blocked because I'm selling a put 140 multiplied by 100 shares represented by a one contract. If it's a cash only account, you got 14,000 get blocked. So how do I trade in if I have a smaller account? Let's create a spread, 140, 135. Right? I ignore this. This becomes a spread. Only $500 of a margin requirement because that's a risk in the trade. And this is a short put spread. Sell a put and then go lower strike price, buy the put. Maximum risk, NVIDIA goes to 40. I'm not losing more than $358 in the trade. I don't care how low the NVIDIA goes, right? So you defined your risk. Let's go to the other side, call side. So that was on the put side. Now we're moving to the call side. Similar structure. You have a short call, and then you basically sell a call, then go to a strike price which is higher, and then you buy a call there, right? So strike price of short call is lower than the long call. This is, instead of selling a call, if it is too much of a volatile stock and you're trying to sell a, let's say, covered call. And I have seen some other folks selling a covered call and then say, oh, why did I sell a covered call? Because my shares got called away. And now the share has, the stock has mooned and I got taken out earlier, right? If you have a lot of volatile stocks, maybe do a spread so that you're still in the game, right? Avoid seller remorse. Going back to NVIDIA. Now, instead of doing a put side, I'll move over to the call side and sell, let's say, 100 and what's an example I'm saying? 150, 155. I'll sell 150 call and then buy 155. So this is a short call spread, right? Ignore the put one. Let's say if I have a NVIDIA shares in my brokerage platform, you can always simulate NVIDIA shares. If 500 shares, a lot of people don't sell calls against it because you're afraid that if NVIDIA goes to 180 and you sold, let's say, a call at NVIDIA at 150, sure, you got $2.90, but if the stock goes to 180, that didn't turn out to be the best decision, right? You would have just made a lot more if you just held the stock. In that case, spread will come out to be better because, hey, if NVIDIA goes to 180, you are still in the game. Okay? And then you do it again. So sometimes if you have only 100 shares and you're really volatile stocks or the stocks that you don't want to get called away, instead of doing just a covered call, do a call spread. Right? But today I'm talking about call spread for a different reason, but this is how you structure a call spread. So Now, what the box is. So we did a put spread, we did a call spread. Now, the box is a strategy in which you do both, right? It's a four-legged spread. So consider it more of an advanced level strategy. Generally, I've not seen retail investors talking about it, but I guess financial advisors, they do it. Institutional investors do it. It's a neutral option strategy. So you have a zero risk of stock movement. Stock could go 20% higher, you're not going to make money. Stock could go 20% lower, you're not going to lose any money beyond whatever the initial trade is, right? What the core concept is to virtually, the lock in a risk-free profit or loss by simultaneously buying and selling options, right? With different strike price and expiration date. So the combined payoff is fixed. I know exactly right now how much I'm going to make or lose, right? And there is no impact due to price change in the underlying. Stock could go anywhere. That's not going to change how much I'm going to make or lose in this trade. I'll explain you why I'm using the word make or lose. Why you would think, why would someone lose? Right? Why would I do a trade if I know that I'm going to lose it? And I'll give you. Hold on. Okay, payoff at expiration. The net value of a perfectly constructed box spread is always equal to the difference between the strike price which is used, and we'll look into it. Why people use it? There is sometimes you get an arbitrage opportunity, right? Primarily used by professional traders with a super fast computers. And when I first learned about the box strategy, it was I think in 2020 or 2021, and I looked at a few tickers, tried to create a box spread, and I could not find it very exciting because I'm like, a lot of a capital got blocked in this, and the money that I make is not that great. Right? I can make that money by holding it in, the similar amount by holding it in a T-bills. So I never actually did a box trade so far until this Friday. So because there was nothing much arbitrage, and I'm a retail investor, but I guess there are, if you can find an arbitrage by using a fastest computers, and you can, you're in a race against those algos from the Wall Street firms, and who are trying to find an arbitrage because maybe some option is mispriced, and you can find a few cents on a trade, but you could do a million trades, right? Companies like Renaissance, right? Maybe you can then, it becomes useful. As a retail investor, there's no way we can find any arbitrage, irrespective of whatever any influencer says, this is not for us. Low risk financing is what attracted me this time. So I knew about a box, but I never used it because there was nothing much arbitrage I could find. You could use as a low cost collateralized borrowing mechanism, which is what our focus will be. You can use it for a hedging because it's a fixed payoff. Not useful for me as a hedging, nor for market neutrality, because I use other ways to basically manage my deltas and stay delta neutral. I'm not delta neutral, but whatever the delta I want to control. Right? But these are the uses, if you generally talk to people or a professional prop firm traders, they might tell you why they want to use box spreads. Right? What are the components of box spreads? So it's a long call and a short call. This is one spread, right? We looked at the call spread, which is basically you have a long call and a short call. Similarly, long put and a short put. This is how you construct a box spread. So you buy a long call option, sell a long call option. So this one, you are buying a call spread, buy a long put, sell a long put. You're buying a put spread. So or you could do the reverse also, which is selling a call spread and selling a put spread. If you combine both of them, long call and a short put, it's a synthetic stock position, right? Allow me to explain what I mean by synthetic stock. If you don't want to hold stock, but you want to get similar exposure as if the stock would move, You can create that just by using just options, right? You go along on the, short on the put side, long on the call side. You get your synthetic stock position, which is your 99.86, close to 100 delta. Your payoff diagram is just like how your NVIDIA stock payoff diagram would be. Let's say if you held 100 shares of NVIDIA, this is your payoff diagram. If you held 100 shares of NVIDIA, this is how your payoff diagram is. NVIDIA shares go higher, you make money. NVIDIA shares goes lower, you start to lose money. You can construct the same thing using options. NVIDIA shares goes higher, you get almost same payoff. So this is what's called a synthetic stock position. I don't own the stock, but I've created in my portfolio, which will behave, if this is the only thing in my portfolio, which will behave exactly as if I'm holding the stock. That way it's synthetically creating a stock position. So this is synthetically long position. I could do a synthetically short position also. This is go back here, right? So your synthetically short position will be shorting the call and buying the put. Let's go back. Now I'm gonna short the call and buy the put. So this is synthetically short position. You combine both, it's neutral, right? So doesn't care where NVIDIA goes. I'm making $100 on synthetically long because the NVIDIA went up $100, but I also have a synthetically short. I'm losing $100 on it. So essentially I don't lose anything. Right? So this is the combination. If you do just synthetic stock. Now, what we are talking about is creating similar box spread in which doesn't matter where the stock will move, you're not gonna have any impact because of stock movement. Now, the question is, why would I even do this? So let's explore this. Right, a flat profit loss across all underlying price movement, like I said, right? So this was a trade that I have done, in which, this is not the trade that I have done, but this is a long box spread, in which if you buy the box, you can make maximum whatever $900. Doesn't matter where the stock has gone on XPX, right? Irrespective of wherever the SPX goes, your payoff diagram is fixed. You know today how much you're gonna make at end of expiration, which is almost 390 days out. Advantages: it's a low risk, right? Because you already know how much you're gonna make or lose. Market neutral, we talked about it. Predictable return. There is arbitrage potential, we looked at it. Efficient capital use. If you are doing it for credit, if structured as a credit, then you generate upfront capital. And this is what I want to focus on. So like any option trade, you can buy an option trade or you can sell an option trade. When you buy an option trade, you have an upfront debit. When you sell an option trade, you have an upfront credit. So now let's look at how to do this box spread for upfront credit, and which will help us to lower the interest rates. Before that, let's look at the margin rates, because that's the whole premise with which we started this conversation. Is I don't have money, or let's say I got assigned some stocks and I did not have a cash. So then what happens is your cash balance goes negative, which means you're borrowing money from your brokerage firm on margin. And this is what the margin rates will be, right? Let's say your short put was assigned and our account didn't have a cash. So when you log into your platform, you will see minus $50,000 as your cash balance. It means you borrowed $50,000 from your brokerage, and Charles Schwab will charge you. If you borrowed $50,000, it will be 11.125% per year. This is like an APY or APR is what they will charge you. Now the question is, if I want to hold this position, I don't want to sell my stock, and bring cash and pay $50,000. Because if I sell some stocks, I'll have capital gains. I don't want to sell the stock to temporarily raise cash. What are the other options I have available? I can go to my credit card company and withdraw cash, but then I will pay credit card charges on an average 26% credit card rates. I can take a personal loan from a bank, right? And Google AI suggests that 13% is a rate on an average. You can take a HELOC. I strongly suggest not to do these things. Don't mix your house with your investment. 8% average HELOC plus you're risking your home. Or you can do box spread trade. For me, seems to be the best option is to maybe use box spread trade and pay much less than any of these options and much less than what Charles Schwab may be charging you. Right. So let's see how we can create it. So this is a trade that I did on my live account, did on Friday. I did 2 contracts of SPY, sorry, not SPY, SPX. Short call spread basically is selling a 6,000 call, buying a 6,100 call. Short put spread is selling 6,100 call, buying 6,000 call. Right? Like I said, we looked at it earlier, it's a zero delta net impact because 6,100, selling a 1,600 put, buying a 1,600 long call is a synthetic long stock. This is synthetic short stock. So long and short both positions. So zero risk, additional risk from a movement of the stock. I got paid $95 per contract for doing this, right? Upfront. So I got it today. So I've got a $95.30 cash for doing this trade on Friday. And this trade goes till 17 July 26. Right? Now, if you recall, the box will trade at expiration at the value of width of the strike. In this case, the width of the strike is, anyone? What's the width of the strikes? Come on, there are some option traders in here. $100. So at the expiration, I have to close the trade. I have to pay back $100, right? So let's look at this. At expiration, the trade will be valued at $100. I have to pay $100 to close the trade. Right? So I'm losing, or call it as an interest that I'm paying, which is $4.70 because I got 95.30. I have to pay back 100. It means I'm paying $4.70 interest on $95.30 principal that I received today for 391 days, which is expiration day, right? Which turns out to be 4.6% APR. And so this is what, $20,000? For $20,000, Charles Schwab would have charged me 12.56%. Instead, so my cash balance was negative. So if I had held that negative position cash balance, I would have to pay 12.57% margin rate to Charles Schwab. Like, what the heck? I will do this trade and got the cash in at 4.6% APR, right? Which is like 2/3 less than the margin interest. So 3-4 years ago, when I thought about a box spread, I was looking at, I can't make more money than, whatever the interest rate was at that point of a time. So as a retail investor, if you're doing box spread, trying to find an arbitrage, max you can make is close to what the Fed funds rate would be. Arbitragers will never let you get that arbitrage opportunity unless you have a supercomputers, the fastest ones, than the hedge fund guys or the whatever, the HFT funds. That time I didn't. So, and I said, there's no point in focusing on box spread. This year, I have a different need because now I'm full-time into this. Hey, I got some SPY short puts assigned to me when the market fell down. and I was holding that. I didn't want to sell the stocks. But then, dude, why go to pay 12%? If I can borrow, if I could make 4.6%, the other person on the side of trade, right? I'll take the other side and not let the other person make more than 4.6% or whatever the current Fed funds rate is. So then I realized maybe use this to just generate a cash upfront and hold this for a year instead of me paying a margin interest or raising cash using any other strategy. Now, are there risks to this? Whenever there is an option involved, there is some risk. So I'm trying to figure out what the kind of risk would be. One is the risk of early assignment. I think I do have a risk and consideration. So let's go through that. Of course, there is a commissions. I'm not including the impact of commissions in this. I have to pay commissions on these 4 legs when I went in. I'll have to pay commissions when I close the trade, which will be another 4 legs. So that is not included, but that's minuscule. Right? Looking at the amount of the money that I'm borrowing. It could be slippage if the market is illiquid. Slippage means between the difference between buying and selling. Right? Let's say I want to close this trade. I don't want to hold this for 1 year long. In case of when you're doing a margin trade, when you're borrowing money on margin, your margin interest starts to kick in, is valid only till the time until you inject the cash in it, right? Say I have a margin, $20,000 I borrowed on margin from Charles Schwab. And 3 months later, I win lottery, I get $20,000, I paid back to Charles Schwab, I get charged interest only for those 3 months. Now in this one, if I were to, after 3 months, if I were to close a trade because I received 20,000, and if it is an illiquid options, right, I may have to pay little more than 1.5, let's say more than 1%. Right? Assuming it's, let's say 4%, or let's say it's a 5% interest rate, more than 1.25%, because the options are illiquid, you may not, and it will be slippage, and you may not get the exact right pricing. So that is another risk. Early assignment risk. This is the risk which many option traders ignore it. And I have seen those traders get burnt out. Even they have a defined risk trades. We talked about of a Tesla trader. We talked about another trader who unfortunately took his own life. And that's what encouraged me to do these sessions is, hey, let's teach each other. Because you could get early assignment. Right? So that's the reason you pick up European options, SPX, because there is no risk of early assignment in SPX. Right? Especially if I don't want to do this in, let's say, Tesla or any other stock that can be assigned early, because then you have a X dividend days. You need to worry about a lot of other factors. Right? So do it on European options, which is like index options. That's why I picked SPX. Also, because SPX is very liquid. Right? If it is illiquid, if you're trying to close the trade, let's say I'm trying to close the trade because 3 months later I got $20,000, and then I don't want to pay 4.7% for 12 months, right? I want to close the trade. If it is illiquid, I may not be able to close the trade because no one is able to take the other side because it's some obscure ticker and the stock has moved and no one is, the volume on those strike prices is not even there. So you have to look for a liquid ticker. SPX, very liquid ticker. Right? And is there any other counterparty? I mean, if you're trading on these exchange traded options, you don't have to worry about it because OCC will take care of you in this case. So these are some of the risks. And I think early assignment risk is the biggest one, but you can mitigate that risk by dealing in European options, like index options, which cannot be assigned early. And then liquidity is another one. If you're dealing in some of these index options, which are heavily liquid, then you also mitigate that risk, right? And that also mitigates the slippage risk. So that's the stuff I think is better. But the question, why doesn't everyone do it? Right? Why would people still take, loan on margin and pay 12% to Charles Schwab? Like stupid people like me, right? Because lack of knowledge. It didn't occur to me that I could have, instead of buying, when last time I heard about box spread, 2020, 2021, I did not have a need of, let's say, the margin stuff. So never occurred to me. This time it did. I'm like, why would hold minus $20,000 in my cash and pay 12% if I can do it take the other side of the box spread trade and raise cash like this way. So then I realized maybe I should do this. And I did it on Friday. Number two is it needs little higher level of trading privilege. You should have a privilege to do spreads. Right? Not everyone has it. Maybe you're allowed to only buy options if you're on level 1, which is a horrible, horrible way to start into options. But that's how brokerage firms want to protect themselves and not you. So they won't give you privilege to sell our options if you're very new to it. Number two, if you level 2, they'll allow you to do cash secured put. Maybe level 3, where they allow you to do spreads. Right? Not everyone may have it. And it will block this buying power for doing the trade, right? So if I've done this trade, it will block whatever $20,000 buying power for this one, for 2 contracts. As long as I'm okay with it, I don't need that buying power. My focus was not to pay that much interest to Charles Schwab. I'll do it, right? But that's essentially is my understanding. And this is the first time I've done it. So I'll see what am I missing in my analysis, but I have a lot more experienced people on options in this group. Pitch in, poke holes in this thesis so that we learn from each other. But I've already done the trade. I'll see how it goes. I think I've taken care of the gotchas that I could think about by picking the right ticker and picking the European option so that it is cash settled and no shares, nothing I have to worry about it, no dividends, nothing else, no early assignments, and I got a decent pricing. The it's not easy to fill. You have to wait. I started with like $97, and and then eventually started to come down and got filled at 95.30. And then when I run the numbers, I'm like, okay, 4.6%, much better than 12.5%, right? So that's all about box spread. Hopefully useful to you guys. If you are looking to finance your cash needs in your brokerage account, use box spread instead of paying margin interest, which is way, way higher. Your brokerage firm will never tell you. Obviously, they won't, right? But you have to think for yourself, I would say. So that's all about box spreads. Any questions or any risks? What I could be missing here? It's the first time I've done it. So poke holes. Go ahead.
This is Sam.
Yeah.
I tried it and it didn't work.
What did you try and what didn't work?
I have lots of calls, right? So I bought two I bought two I sold something, 2 puts, and then one of them was called in and they took my shares. So I don't think it worked, or maybe I didn't know how to do it.
No, I think this is different. You're talking about different stuff. in this case, I mean, I don't hold any SPX in my portfolio. This is just a option trade. So my question was related just to the box trade. Let me see some of the questions. This works with cash settled stocks. No, I mean, you can, Ramesh, you can construct it on any stock, but like then you run a risk of assignments and all that on other stocks, right? So my intent was just to raise cash at a lower interest rate, right? Not to find an arbitrage opportunities on the stocks that I hold in a portfolio and all that stuff. Because that I tried a few years ago. There is no way I could have done that. Dave is asking European option. How about expiration date? You cannot close it out till the expiration date. No, you can close it out anytime. European options means you cannot exercise your right to either buy or sell the shares. But if you want to close an option trade, I can close it out tomorrow if I want to. You can do this trade and collect a little less. There's another trade Shri has suggested. Could you please expand on that blocks 20K buying power? So when I say buying power, this is what I mean. Let's go back here. Let's go to SPX. And I don't know now it will show the SPX or not. Let's go to SPX. Let's pick up, mine was 17th July. No, 26. I went to 26, right? Not April, 17 July. 26. Because when I did that time, hold on, let me go back and look at what was the stock was almost close to 6,000. Okay. All right, let's try to do the exact same spread. Was put side is 61. This and then this and this. What am I missing? I sold a call at bought this and then oh, this should have been sell and this should have been buy, right? 95.50. Do one contract. So margin requirement $10,000. I did two contracts. So it will basically block, means I can't use $20,000 for anything else, right? So right now my option buying power is telling me $100,000, right here on the top left where my mouse is. If I do this trade, $10,000 get blocked, right? That's what I meant to say, that your buying power will get blocked. So I did two contracts, so that'll become 20K. Have never used margin interest? Yeah, then you don't need to. I never used margin interest until this year because, I always had a salary cash coming in, but now I have to be a little more cautious in terms of, you know, I have to generate cash from my investing activity. And now since this is my full number, I can be a little more cautious on okay to get, let's say, hold a little bit of a margin on my portfolio. It was not intentional. After the April tariff scare, when the stocks fell down, I was assigned some SPY contracts and QQQ contracts, and obviously I did not have so much of a cash, so my account went in negative cash, and I didn't want to sell. I'm like, it will recover from this tariff stuff, so I held it. And then, after it recovered, I started selling a bit of it, and I still have a little bit of a negative cash. And then I realized if I known this, I would have done this trade the moment those short puts got assigned, which was in April, right after the tariff stuff. So I could have done this trade immediately had I known it at that point of a time. But it's okay. There is always, new things that you learn. Do you have portfolio margin? Yes, I do have portfolio margin.
Vivek, take a look at my the iron condor that I created. You will get $90.20 and your risk is still the same 10 points, I think that would be a better trade than the one that you have.
Let me try that. Paste. So this 1920.
Uncheck your first one.
Oh, sorry. Yeah, a little bit of so why would you say this is better?
Because it widens the spread, so it is much further away.
Okay, so okay. Yeah, so I do sacrifice a little bit of a premium, but then it may happen that the stock never go beyond this, and then I, basically I don't have to pay the $10, the risk
Right.
I'm incurring here. Yeah, but
Change to the one that you had selected and take a look at that one and this one. Uncheck this one.
yeah, this is a confirmed a loss of $450 per contract.
Yeah, but you have a much higher probability of making a profit with the trade that I placed for you.
Okay, so I am not that I will because then there is a higher probability of trade, but if the trade goes against you, let's say it moves beyond it, then I lose a lot more money and generating less cash. I agree what you're saying,
But the break-even points are wide apart than what your narrow range is.
oh, mine is not on range. Mine is 100% sure that I'm lose $4.50, and that's a surety or the guarantee that I want to have.
Okay.
For this purpose, because my purpose here is just to not pay that much amount and guaranteed. In this case, it's a probability, but not a guarantee.
Nothing is guaranteed in options.
No,
but
in
you
this
have
one, in this one, I'm guaranteed that I'm not going to pay more than 4.6%.
It's the same thing over here.
No, if let's say the stock goes all the way to the beyond my cost, right? I'm gonna lose $10 instead of $4.50, right? My loss on this trade will be $9.80. In this trade, it's
But if you take a look at it, it is easier to cross 6,100 much easily than 6,200. So that on that basis alone, the probability is more in your favor at this point with the second one.
I have done this second type of trades lot. I mean, I have a lot more these trades in my portfolio. But I'm saying the intent of the box spread is I want to have a guarantee that I'm never gonna pay more than what Charles Schwab is charging me. And that serves the purpose. I understand what you are saying, but the purpose here is different. I don't want anything.
I understand, but you have a higher probability of profit in the second one that I put in, and then the other one. The other point that I want to make is that the box spreads are designed to be done one at a time, not put the whole box spread. You take a position, a call spread or a put spread, and then do the opposite, and so that you make sure that you have no losses in that altogether.
Lot of people will do the whole idea is when you do that, first of all, I don't know if you know how you are able to find those kind of opportunities, but if you are doing it like an arbitragers, yes, you will do that. In this, like my intent was different, right?
I understand, but what I'm trying to show is that there are other ways to do the same thing. in a different way.
But
Again, if you think that the market is overbought at this point, I would put the call spread first and then wait for it to go down and then put the put spread, and then you will be collecting a higher amount of premium altogether, and you don't have any risk of having any problems with the $4 or whatever that you have.
Yeah, I have like 50 other trades which for that one, which I already have in my portfolio. So this one was just specifically to get around the margin interest rates.
I'll be tempted to do this sort of thing if ever my mortgage goes to like 8% or 10% old structure.
I want that guarantee that not the 99% probability.
Absolutely. It's 100%.
Yeah.
Like, yeah.
Like I said, right? I have a 50 other trades, which is like on probabilistic way.
Yes.
In this case, my only intent is I don't want to pay 12%. And there's no way in a world that could force me to pay more than what I've calculated, which is 4.69%. For that specific purpose, box trade works out for me. And what tree you have suggested, yeah, those iron condors and all that, like all my other trades are related to that anyway.
I have a thought. All
right.
Shri,
sorry.
Okay. What Shri is talking about and what Vivek is talking are two different setups. There's no comparison here. Iron condor is meant to be in such a way that there's a huge spread, or you define the spread and accordingly define the premium. So coming back to the box spread, Vivek, I'm locking in, or rather putting the money into sort of a escrow account to get that credit. So what I'm benefiting really?
No, it's not cash getting locked, right? So I don't have a cash in my account. It's just a buying power.
Yeah, buying power is cash.
No, it's not cash. I have a negative cash account. That's why I did it. It's a buying power comes from a lot of stocks, etc. that I hold.
Okay.
Right now, I've utilized only 25% of my buying power because I'm not too, I still see little frothiness. If the market goes down, then I'll utilize a lot more buying power. I'm utilized only 25% of my buying power.
Yeah, I got it. I think you're right. Because you have other collateral to cover.
I have a lot of stock and other stuff on my portfolio. I just don't have a cash. So when I got SPY contract assigned, and we go back and look at it, I think in April, like when I tell what I buy or sell, I talked about it. I got SPY in my account because the stocks got assigned. I got like 2 contracts of SPY assigned, and which means that was like 570 strike price, which is like 100,000 whatever, like $114,000, right? I did not have that much cash. Immediately went negative, and I had that position because I did not know about this. I would have done this long back. So
it is pretty good for margin accounts, not applicable for cash accounts.
Yeah. On a cash account, you can't even have a negative cash because the brokerage will sell something. It's only good. It only works good if you have a margin account. Otherwise, that's where the margin interest and all that discussion comes in.
Yeah. Okay.
All right. Okay. Damn. I hope it was interesting. I always want to share something new that I learned. And I found it in a better way to raise cash than doing personal loan or HELOC, etc. Right. And now I think, let's say if the like Aditya was saying, that if the interest rates goes 8%, etc., you want to raise some cash and pay it off your mortgage a little bit, maybe look at this. But I think at a higher level, you're not gonna make more or lose more than close to what the Fed's fund rate would be. Only arbitrageurs can do it. I think as a retail investor, we can't find an opportunity to, let's say, make more. Let's say if I were to buy this box spread, I sold the box spread, I would have to pay maybe $4.50 or $4.60, right? Exactly opposite, 100 minus this. And at the end of a year, I will get $100 back. It essentially turns out to be 4.67%, which is close to where the Fed funds rates are. So if we are trying to figure out, can I use the box rate to find arbitrage opportunity? I don't think that is possible. And that's the stuff which I thought I went with box spread few years ago and I didn't look at it. But today, for a different need, I think it found a place in my portfolio or in my wheel box. This is a tool which I think I can now use it if ever my brokerage firm, my cash account goes negative. Instead of paying a margin interest to Charles Schwab, which is 12%, I would rather pay what's the closer to the Fed funds rate is. All right, so it is 102 slides. I'm not doing 102 slides. So I went through the 102 slides of 102 or 120. And I picked up the things that I thought would be interesting for our meeting. 3rd-Coatue Management LLC is a fund. They invest in private companies. Also, they invest in public companies. When I reviewed the 13F consolidated filed by almost 80 fund managers, I did look at what 3rd-Coatue holds. So maybe I'll bring that back up. But before that, let's get in and try to understand, go through some of those interesting charts that they had shared in just in their keynote address, right? So one is innovation waves, right? Starting with the mainframes in 1960s, PC, networking, internet, mobile, cloud, and now the AI. So if you look at each of these waves, just like the C waves, they built upon the strength of the prior ones, right? The energy coming from mainframe got passed over to PC, wave little higher. PC got connected together. Networking would have happened if we didn't have a PCs, right? Individual PCs to connect to, which then once we got the connected PCs, we could have it in an open network, became internet, mobile internet, cloud, and now the next one is AI. Leading to outperformance in the long run. On the tech side, $1 invested in tech, NASDAQ 100 would have been 228, Dow Jones, $90. Because of over the past few decades, we have seen the technology stocks have become bigger and bigger portion of our overall indices. They've been performing better and better than the rest of them, right? How big can AI be? Right. So this, I've not seen this chart anywhere else before in terms of stock concentration, sector concentration as percent of US total market cap. In 1800s, most were related to real estate and finance, right? Bonds. What else was in the stock market? Not much innovation, right? Companies will raise money, offer bonds, or you have a real estate stuff. Then the manufacturing, boom started coming in 1880s, early 90s. We have industrials and transports, right? Railways, canals, all comes under transports, right? And then you have industry. Steam engine came in, we started getting electricity, industries started to set up industrials. Then energy and materials were the biggest portions, close to like 40% at a peak, 45% of our US stock market. Right. Then 1972 was the Nifty 50s, where we had some of these tech companies, Kodak, Polaroid, IBM, RCA, right? And those Nifty 50s came in then, I think 1980, 84. I don't know what these were. And then we had this boom of the tech companies, right? And then over the last 15 years, is with the tech companies with the different names, right? We had a FANGs, then you have Fan Maga, Fan Mag, and now we have a Mag 7. Probably we'll have a Mag 6, and now the new term is yet to be coined for the AI ones. How the tech leadership has changed, right? Over the past many years, 2015, top 10 were 31% of the NASDAQ. I guess this is this talking about TMT universe, telecom, media, and what's the third T? Telecommunicate. Telecom, I already said. Technology. 2015, Apple was the biggest one, $750 billion. Top 10 were 30%, top 25 were 47%. 2020, 5 years later, Apple is $1.4 trillion. Top 10 became 39%. Little more concentrated, getting top heavy because the bigger companies became bigger. Today, now we're talking about $3 trillion companies. Microsoft, Nvidia, Apple, Amazon is at $2.5 trillion. Top 10 is almost 50%, 47% of the total of TMT universe, becoming top heavy. And also, the leadership is changing. We had Alibaba as top 3. Alibaba is not way down here, right? After 10 years, Alibaba is way down. Hasn't returned anything, $227 billion to 269. So if you had invested in Alibaba at the start of when it IPO'd, probably not made much. And new companies are coming. Tesla wasn't even there in 2015. Now Tesla is like in top 10. TSMC was there, and still there, right? So leadership is changing. That is why I say that investing in QQQ is better, because it is very difficult for the companies to always stay on the top. So these headings are from me, my interpretation, or what is the message I want to convey. Slides are from Coatoue's deck, okay? So this slide number 9, they say it's hard to stay on top because 1/4 to 1/3 of top 25 has changed every 5 years. So either you are smart enough to know which companies will be in top 25, because every 5 years you will see 1/3 of the companies have changed, right? But it's been the lowest since 1995. Right now, only 16%, because looks like in the last 5 years, from 2020 to 2025, the companies that were on the top in 2020, fewer companies have changed the top position, right? But historically, we'll see almost 1/4 to 1/3 will change. So from my perspective, I'm not that smart enough. I would then just invest in QQQ so that I don't care who changes in the leaderboard. I will always have invested in the top 100 companies. Okay. Those got dropped out from the top. They always had underperformed, right? Most of the time. So if you look at 2015, only Booking Holdings had outperformed NASDAQ. All these are the dropouts. They all underperformed NASDAQ. Since 2020, none of them has outperformed NASDAQ in the last 5 years. The dropouts generally underperform. That's another reason. Maybe just buy QQQ. I don't want to be, become too egoistic and say, no, I know which is the next winner. I can find out the next winners, right? Though I try hard, right? But let's be aware that even the smartest people can't, 85% of the Wall Street firms and the fund managers can't beat their own indices. So what to talk about me try to beat it? I'd rather own QQQ. We've seen that the Max 7 returns last 5 years have been amazing. Year to date, it's not been that great. Meta is up 17%. Maybe a little less now because the slides were probably a little older. But I think you get where the wind is blowing. The direction of the wind is right. Meta, Microsoft, Nvidia positive. Everything else is negative. Maybe there are new AI leaders that will emerge out of you, right? May not be Max 7 anymore. Maybe we will have something new that will come up. Okay. So, oh, come on. Some of the new ones in the AI ones are a lot of focus on AI power, GE Vernova, Constellation, Vistra, focus on electricity shortage, right? That's where we see like Oklo, $0 revenue, but stock is up so much. AI software, companies that use AI build AI agents, like agentic AI is the new hot name. Palantir, don't even ask me about that. We talked about it, umpteenth number of times. Oracle, Snowflake, focus on the tailwind of AI hitting the semi companies, Broadcom, TSMC. That also includes NVIDIA. right? So there are new companies that are enjoying the tailwind, right? Coatue believes it's an AI super cycle, right? We'll talk about these cycles. Now they think this is an AI super cycle, will consume energy from all these and will be much bigger, at much bigger magnitude than what they have ever seen, right? Chat GPT, and there is some evidence to it, right? Chat GPT is growing faster than anything that we have ever seen before. It's like there's no comparison. Facebook is like here. TikTok, we thought, is growing faster than Facebook. Right? Look at chat GPT. Okay, I'm hearing some background noise, so let me mute. Yeah, if you're not, please stay on mute. Okay, I've muted Shri. Right? Look at the growth on the chat GPT users. What else? So does this sound trouble for incumbents? Maybe, may not be. So this what shows is that the users who have used ChatGPT, right, paid version, it shows their usage of Google has gone down. Like 2 years after they start using ChatGPT, their usage of google.com prior to search has gone down close to 8%. We all know that Google, I mean, even if the Google search usage probably has come down, anecdotally, my own usage has come down. Google is still making lot of money on their search, but I know that my usage of Google search has come down. That doesn't mean I'm not paying to Google. A lot of the usage has shifted to Gemini. But this is true. Incumbents are facing some headwinds because these AI powered applications are taking some of their, have knocked wind out of their sails. There could be a new breed of hyperscalers. So far we have 3 or 4 hyperscalers. Big one is Microsoft, Google, Amazon. What they project, right? This shows how much of a share of NVIDIA GPUs would be. CoreWave will have close to 11%. Oracle will have 19% of NVIDIA GPU, which they call as a new cloud. There was a question around what is happening to Oracle. They secure a lot of NVIDIA GPUs. They're trying to become AI specific cloud by offering it, right? Right or wrong business model, only time will tell. Coatue is very bullish on CoreWave. I'm not that bullish on CoreWave because your business model is just renting out the GPUs, right? One big supplier, few big customers, but they think the CoreWave could become the next big cloud challenger to the AWS and Azures of the world. What the risk to the AI story? Maybe market is expensive. Tariff could lead to an end of US exceptionalism, and our deficits could continue to balloon, right? And historically, we have seen that when the market is expensive, market will, sell off. So this shows top 5 quartile 5-year CAGR happens when the market is trading at much lower valuations, right? These things, when the market trading a higher valuation, these are the red ones. These are the bottom 5 market returns for the next 5 years. So right now, it's trading here, which is like neither here nor there, neutral, but little bit more on the higher side. So maybe the market is elevated, and hence maybe the future returns that won't be that great. Tariff concern that spooked the investors. This was the worst stat to NASDAQ since its inception. April, when we are like negative, through April 21st, negative 18%, right? But we also know that the tariff drawdown didn't last long. So they have done a drawdown studies across, multiple crises, .com, GFC, COVID, Black Monday of 1987, Gulf War, long-term capital management blowing out, sovereign debt crisis. Powell pivoted to increase the rates and then had to walk back, and then inflation concerns, and now the tariffs. What? We had a drawdown for 7 weeks and then we recovered back in 7 weeks. The smallest, narrowest drawdown of all of them. Right? And then there are some policy changes that could be the tailwind. Right? We talked about it in terms of some deregulations, which will give a lot more focus to or make it quicker to do this energy plus nuclear renaissance, and the end of a AI diffusion rule, which I think if they have done this deck on Friday, they probably would not have put this in, because on a Friday, the administration kind of rescinded it. But I think administration also understands it's a negotiating game with China, right? So eventually, I do believe that our companies will be able to sell to other, to companies in China. Otherwise, the market in China and then the rest of the world could be taken over by Huawei and Chinese technology. China will move forward on AI with or without US tech. Let it be very clear. The question is, do we want them to be on their own stack or do we want them to be on a US based stack? Right now, they are open to get it on US stack because their own stack is not that great. But if you're not going to tell them, not going to ship it to them, they'll build their own product, which is competitive to US technologies and maybe better. Then they won't even need US tech. We would have already lost that game then. I can skip the AI flywheel. There are a lot of concerns around deficit, right? And what they said that, the forecasters, many of the times they are wrong. In 2000, when they forecasted for in 1993, they forecasted that in 2000 productivity gain will be 0.8% from usage of internet and new technologies. Actually, productivity gain was 2%. And they had forecasted that a debt to GDP ratio will be 61%. It turned out to be 34%. So when we're looking at a deficit, we should not look at deficit only as an absolute number. It always has to be with respect to GDP. So debt to GDP is a better measure to look at than the absolute debt. So absolute debt in 2000 probably was higher than what it was in 1993. But then we also grew our economy at much faster rate than the debt grew. So the debt to GDP ratio actually came down. So what they think today, the consensus is that in 2020, so today our debt to GDP is 98%. 2034, what they think, the consensus is that it will be up to 140%, which is huge. But Japan is more than 200%. So it's all relative. What Coatue thinks is because of the productivity gains on AGI, we also will grow our economy, that the debt to GDP will be close to 100%. Or if you get a artificial super intelligence, it will be around 80%. Right, which will be even better than the situation that we are in today with much higher debt level because our GDP grew at much faster pace. Then they talked about IPO. This was basically the IPO that came out during ZERP environment, 2020, 2021, zero interest rate policy. Those IPOs are still down, on an average 44% after a 1-year return, and then 52%. So if you bought at IPO in 2021, right, as of today, on an average, you're down 52%. Not that great. But this is changing because we had a recent IPOs that have come in, right? 2025, the recent IPOs have gone up. So winds may be changing. Now we are seeing some companies are like 200%, 600%. Big start to IPOs in 2025. And there are a lot more S1s that are in a backlog. Bullish, Genesis, Gemini, and all that stuff. By the way, this does not include SPACs. This is the TMT stocks, because Coatue is generally focused on the TMT sector. This is not the universe of all the IPOs, but the IPOs in the TMT sector without including SPACs. If you include SPACs, the situation will be even worse because some of the SPACs are down 90%, 98%. Right? We'll skip this. Maybe we'll talk about this. Growth is increasingly scarce in public markets. Today, only 5% of the software companies in public markets are having more than 25% projected growth for next 12 months. Right? It used to be much higher in 2021, 22. It's our growth rate of the TMT segment. It's, growth rates across the companies going down. So there are fewer and fewer companies who are growing at more than 25%, right? On average, it's close to 5%. So because the growth is scarce, market is rewarding the companies with much higher multiple that are growing at 25%, right? Because there are very few companies are doing it. So what you are getting is if the company is growing more than 25%, market is willing to give 13x multiple of it. And that multiple has been increasing because there are fewer companies. That's why there was a question around, oh my God, PE is so expensive. Yeah, because there are few companies who are growing at that pace. You can't find them. So you pay up more for these companies which are growing at this pace. They talked about impact of AI on headcount, right? Which is, has Microsoft reached its peak employee count? When you needed, earlier when we did not have AI generating code, the only way for the software companies to grow was to get more and more software engineers, hire more bodies who can write more code. Now to write more code, you don't need more bodies. So maybe this is the peak of software engineering jobs. There will be AI related jobs. There will be other jobs that will get created. But the question is, maybe for these Googles and the Microsofts and Amazons of the world, maybe they might have peaked in terms of their software engineers. Right? Look at a case of AppLovin. Is they've reduced their headcounts, right? From their headcount is all right here, which is not reduced, but there almost no growth in headcount, and the revenue has grown from 3 billion to almost 6 billion, right? So which means revenue per employee almost doubled because they use AI. I'll skip this. This is mostly this is the more important one which I want to talk about. Today's leader on tech, right, are these Microsoft, Nvidia, all the names that we are familiar with, right? All top 50 tech companies. They constructed a new list which is based on top 150 tech public and private companies today. And then they looked at their 5-year CAGR. They excluded the companies which have which faced multiple compression, right? Not multiple expansion, but multiple compression. If they think that this company will have multiple compression, they took them out and created their own list of Go-To Fantastic 40, right? Which is this list. For 2030, 5 years down the line, this is their next list of Fantastic 40 companies that will have a multiple expansion and who will be, in the list. So they said they made a huge announcement without saying so or putting it anywhere, right, in this list. What's that announcement? Without saying, they made a big announcement. There's no Google in it. There's no Apple in it. Per Coatue, they think Google probably going to face multiple compression because of their search is getting, disrupted and all that stuff. And Apple is so far behind in AI that, they're not going to have any multiple expansions. So from their perspective, this is not my perspective, this from their perspective, these are the companies that they would want to focus on. Okay. The new Fantastic 40. Should you believe what they say? They have their own report card. And I applaud them for being open. How have we done on our big calls? 2021, they had a big call around work from home, right? Zoom's gonna be the next Apple kind of a stuff. It fizzled. They completely missed the crypto stuff. And 2020, 2021 was a big bull run on crypto, where every retail investors was, getting in crypto. A lot of institutions were getting in. Coatue stayed out. They missed that. 2022 macro meltdown. There was a mid drawdown, but AI had, solved saved the market. I mean, markets were down, but only for 2022. But in 2023 and 2024, they rate themselves as A plus. So it's not that they were always right. They have had their own shares of failures as well. So based on that, now you can decide how much faith you want to put on these top Fantastic 40 list. That's a quick overview of 20 slides out of 102 slides from Coatue.